Okay, in this video I wanted to discuss the notion of articulation. The FASB uses the term articulation to describe the notion that financial statements are interrelated. So, in the FASB's SFAC 6 elements of a financial statement, they define 10 interrelated elements of a financial statement. You can see those here. Accountants understand this. IFRS basically does exactly the same thing. They define a little bit different elements, but pretty much the same thing. Note the term interrelated elements. In addition to the elements, SFAC 6 defines 3 assertions, or the interrelationships. So actually, assets equals liabilities plus equity, the accounting equation, is defined above the FASB. It's defined by the double-entry bookkeeping model. And the next two, comprehensive income, these are not explicitly defined, but if you read the conceptual framework, the first one is very clear. They kind of say exactly this, and then the second one is implied. The third one is implied. The third equation can be simplified into basically the formula of roll forward equity, beginning equity plus investments by owners minus distributions to owners plus comprehensive income equals ending equity. So these are the interrelationships that exist, the assertions that exist. In addition, SFAC 6 defines 3 structures. It defines a balance sheet, an income statement, and a statement of changes in equity. So actually it's not really defining them here. There's another standard part of the comprehensive framework that actually defines it, but they imply that these 3 statements exist, and no accountant would refute the notion that these 3 statements exist in a financial statement. Plus the evidence of thousands of financial statements shows that they exist. Okay? So here are the structures. And these are simple financial statements, basically. You have the income statement, changes in equity, and the balance sheet. You can see those here. So the notion of articulation is that the concepts are defined in terms of, some of the concepts are defined in terms of other concepts, which causes these 3 financial statements to be tied together. Comprehensive income is tied to the changes in equity, and the beginning and ending balance of equity are on the balance sheet. So you can't change one of these numbers without affecting another number. So basically that is the notion of articulation. Okay? So, and these are all the pieces of SFAC 6 represented as a logical system. You see the 3 structures, you see all the terms, the structures, you see that the system is consistent, complete, and precise. Okay, so this fits into that same model that I showed in the other video about logical systems, of financial report being a logical system. So keep that in the back of your mind, that this will come up again. But there's one piece that I want to add, because it's really a 4-statement model, it's not a 3-statement model. I don't know why SFAC 6 does not define net cash flow. The IFRS conceptual framework does define net cash flow. Okay, and elsewhere in the conceptual framework, net cash flow is broken down into operating, investing, and financing activities. And again, no accountant would dispute any of this. So you really have a 4-statement model of interrelated concepts, and the statements are all tied together. And again, this is all approvable properly functioning logical systems. So here's another case where I'm showing that that a financial report is a logical system, and every accountant understands this stuff. And why is that important? Okay, why is articulation important? The reason articulation is important is because computer software can leverage articulation. If the core financial statements are mathematically interrelated, software can check to make sure that these interrelationships are intact. And it's improper for software to ever allow a financial report that does not have the characteristic of articulation. And the many disclosures are connected to the line items of a financial statement. They break the line item down further, so you have even more relationships within a financial report. And most of these are roll-ups and roll-forwards, and software can again help accountants create these reports correctly and manage the reports. Today's software doesn't do any of that. That's why there's so many errors in reported actuarial-based financial reports that are submitted with the SEC, because software doesn't do this today. But I guarantee you software in the future will do this. I have software that does this, and there's another software application that can check to make sure this articulation is intact. But anyway, I'm going to stop there, and more to come.